All right, let's jump right in. The UK tax system, it's designed in a way that, well, most people just don't understand. But hidden inside are a set of rules that, if you know how to play the game, can totally change your financial future. We're going to break down one of the most powerful strategies the wealthy use, and we're going to do it right here in the UK context.
It really all boils down to this one question, doesn't it? How on earth is it possible for someone making millions to end up with a lower tax rate than their own employees? The thing is, it's not because they're breaking the law. It's because they're playing a completely different game, with a completely different rule book.
Now, for most high earners, this number is painfully familiar: 45%. It's the top rate of income tax here in the UK, and that's even before you start talking about national insurance. It can honestly feel like you're being punished for earning more. If your main way of making money is your salary, you are, by design, in the most heavily taxed group there is. To really put that 45% into perspective, think about it like this. It's like working from January all the way through February, March, April, and into May just to pay your tax bill. Almost half the year is gone before you're even earning for yourself. This is what we call the salary trap.
So let's dig into this salary trap a little more. It's this system where working harder, getting that promotion, earning a bigger paycheck, it can feel like you're just running on a treadmill. You put in more effort, and the government just takes a bigger and bigger slice of the pie.
And just look at the difference here. If you earn one extra pound through your salary, as much as 45 pence of it can go straight to the tax man. But if you make that exact same pound by selling an asset you own, say some shares or a property, the absolute most you'll pay is 24 pence. The system is sending a really clear signal. It taxes your work way more heavily than it taxes your wealth. And believe it or not, it gets even worse. There's this sneaky thing called fiscal drag. What happens is the government freezes the tax bands, but inflation keeps going up, which pushes wages up. So that pay rise you got just to keep up with the cost of living, it actually pushes you into a higher tax bracket. Your spending power hasn't actually increased, but suddenly you're paying more tax. It's a stealth tax.
Okay, so if the salary game feels rigged, what's the alternative? Well, this is where the big strategic shift happens. The wealthy get this. They understand that the rules are completely different once you stop focusing on earning income and start focusing on owning assets.
So, the absolute key here is this. Instead of chasing a huge salary, which gets taxed to death, the entire focus shifts to buying things that grow in value all by themselves. We're talking about property, stocks, maybe your own business. They might only pay themselves a tiny salary, just enough to get by, while their real wealth is quietly growing in the background, completely untaxed.
And this right here, this is the golden rule. The whole strategy is built around one simple but powerful idea. How do you get your hands on cash to live your life without actually selling your assets? Because the second you sell, you create what's called a taxable event, and that's when HMRC suddenly pays attention. The goal is to avoid that moment for as long as you possibly can.
So let's get into the nitty-gritty of how this actually works. How do you turn a valuable asset into cash without selling it? This is the buy and borrow part of the plan, and it's basically the engine that makes this whole thing run.
So here's a really classic example. Let's say you buy a property for £200,000, maybe with a mortgage. Over the years, because of the market and inflation, it's now worth £400,000. Now, you haven't sold it, so you haven't paid a penny of tax on that 200 grand gain. But what you can do is go back to the bank and borrow against that new, higher value, releasing, let's say, £150,000 in tax-free cash.
Now, this is the part you absolutely have to understand. It's the most important piece of the puzzle. That £150,000 that just landed in your bank account, HMRC doesn't see it as income. It's a loan. It's debt. And you don't pay income tax and you don't pay capital gains tax on debt. You've just unlocked the growth in your asset completely tax-free.
This quote just nails the mindset shift required. For most of us, debt is this scary thing we're taught to pay off as fast as possible. But in this strategy, debt isn't a bad thing. It's a tool. It's the key that unlocks the value of your assets without triggering a nasty tax bill. Okay, but wait a second. You might have heard about the American strategy called buy, borrow, die. The idea there is you just do this your whole life, and then you pass on your assets tax-free when you die. Well, here's the huge catch. That just doesn't work in the UK. We have a massive complication called inheritance tax. I mean, just look at the difference between the US and UK systems. It is absolutely staggering. In the US, you can pass on up to $15 million tax-free.
In the UK, our basic allowance is just £325,000. It's not even in the same league. And it means that holding on to all your assets until you die is a recipe for a giant tax bill for your family.
And we're not talking about a small tax bill either. Anything you own above that tiny allowance can get hit with a whopping 40% inheritance tax. Imagine that. You spend your entire life building wealth, only for nearly half of it to be taken away right at the very end. The die part of the strategy? Yeah, that needs a serious rethink over here.
So we have to adapt. The UK version of this strategy is a little more of a mouthful, but it works. It's buy, borrow, sell, gift, die. We have to add two crucial steps right in the middle to deal with our inheritance tax problem.
So here's how the clever part works. Instead of holding on to everything and facing that 40% tax at death, you strategically sell some assets during your lifetime. Now, you will pay capital gains tax, but remember, that's capped at a much lower rate, like 24%. Then you gift that money to your kids or put it into a trust. And here's the magic bit. As long as you live for another 7 years after making that gift, it falls completely outside of your estate. It completely bypasses that 40% inheritance tax.
Okay, we've covered a ton of ground here. So let's just boil this all down into what we can call a new wealth mindset, with a few key principles you can take away from all this. First off, shift your focus from just earning a bigger paycheck to building a solid base of assets. Second, you have to learn to separate good debt, the kind you use to buy assets that grow in value, from bad debt, which is for stuff that loses value. Third, and this is a big one, plan your tax strategy, especially for inheritance, way in advance. And finally, never forget the core rule. You don't sell the asset that's making you money. You borrow against it.
So let's end with this one thought. The UK tax system isn't necessarily broken. You could argue it's working exactly as it was designed to. It's set up to heavily tax labor and lightly tax capital. The wealthy know this, and they've structured everything they do around that reality. So the real question isn't about whether the system is fair, but about understanding the rules and deciding which game are you going to play.